Holy smokes, everyone. What an absolute wild day it was in the markets. We have so much news to cover today. What exactly are the banks doing right now? You're not going to believe some of the new announcements the banks have just released. We've also got more news, exactly what's happening inside the banks, what's happening with banks' loans, what's happening with defaults, bankruptcies. It's been a crazy 24 hours, not just what happened with the banks, what's happening with the US State Department issuing a worldwide caution alert, what's happening with stocks, bonds, what's happening with oil. Oil is surging. What's happening to precious metals? Remember what I told you, when things really hit the fan, precious metals will begin to soar, and that's happening right now. We've got so much to cover today, everyone. You are not going to believe this. So without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. So look at this. Big banks are quietly cutting thousands of employees, and more layoffs are coming. So, unlike they're saying, people, are the banks strong? This does not look good, and I'll show you why they're cutting tens of thousands of positions. So it says here, I'll go ahead and adjust it so it's a bit easier for you guys to follow along and read. So it's a bit bigger and, like I said, easier to read. So the next five largest US banks cut a combined 20,000 positions so far this year, according to companies' filings. That's right, 20,000 positions gone, but it's about to get even worse. So a key factor driving the cuts is that job hopping in finance slowed drastically from early years, leaving banks with more people than they expected. But this is not the case, everyone. Let's dive deep in this report to find out what's really going on. So job losses in the financial industry could put pressure on the US labor market in 2024, which is just around the corner, faced with, look at this, rising defaults on corporate bonds and consumer loans. This is the real truth, what's really going on. I'll show you in another article, defaults, bankruptcies are surging, and you're going to have lots of people default on their auto loans, which is what we're seeing right now, their credit card loans, because just to exist is becoming too expensive. Okay, lenders are poised to make deeper cuts next year. So it says here, they need to find levers to keep earnings from falling further and to free up money for provisions as more loans go bad. By the time we roll into January, you'll hear a lot of companies talking about this. So it won't just be the banks, everyone. I think in January, after the holiday season, yes, companies, this is very seasonal. They normally hire coming into the holiday season to help with Christmas sales, etc. But after this Christmas is done, which I think is going to perform very, very badly, because most people, all their money is just going into the basic essentials. They don't have any discretionary money left over or any disposable income to spend on discretionary items. And I'll show you in a moment what businesses are defaulting the most. And we're going to see the unemployment rate officially tick up next year. So they say here, they need to find levers to keep earnings from falling further and to free up money for provisions. That's meaning as more loans go bad. Okay, that's like what we said before. We'll go ahead and read this other one here. The deepest reductions have been at Wells Fargo and Goldman Sachs. So maybe it's something to watch. As the institutions are wrestling with revenue declines in key businesses, they've each cut roughly 5% of their workforce so far this year. Now, Wells Fargo job cuts came after the bank announced a strategic shift away from the mortgage business in January. And look at this, 50,000 employees have been sacked or have been laid off over the past 3 years. And they said that their shrinking headcount is not over, everyone. So the banks are not strong like they're saying. We're seeing their revenue decline. We're seeing, which I'll show you in a moment, their deposits decline. And look at this next article, which I'll go ahead and bring up here. So bankruptcies are surging, and according to Business Insider, Fed rate hikes are to blame. So we can see here, as Fed starts rising, lifting interest rates, US bankruptcies filings are increasing as well. So it says here, bankruptcies are surging this year and on track to outstrip 2020, potentially setting up 2023 to be the worst year for corporate bankruptcies in over a decade. That's right. All the people wondering, where's the crash? When is it happening? It's happening now. It just doesn't happen overnight. This can take months or years to play out. So, the September data for bankruptcy filings are out, and more companies are going bankrupt because of Fed hikes. And the Fed has raised rates 11 times, as we know, since the start of 2022. But this is what I want to show you, this chart here. So 2023 bankruptcy filings and what sectors? So consumer discretionary, like I said, this holiday season is going to be very, very bad for these businesses. They're the ones that are defaulting the most. And why? Well, it's because of inflation. Like I said, people only have money to buy the essentials. They don't have money to buy discretionary items, and these businesses are going bust. Also, there's healthcare here, but I did hear something somewhere that Pfizer apparently is in big trouble as well. I don't know what's going on with them, but I remember just seeing that headline today. Industrials, okay, they're seeing it tough, but look at this, financials, which includes banks, okay? There's been 31 bankruptcy filings, and you can see the rest here. So there is lots of bankruptcies happening, which will lead to much more layoffs and more problems for the banks, because look at this next report. Big bank loan volumes continue to decline as deposit outflows return, okay? I'll go ahead and bring up this chart here. On a seasonally adjusted basis, I'll move this here, adjust this here, move myself so you can read that. So on a seasonally adjusted basis, deposits dropped by 12 billion, okay? Now, that's what's happening in the banks. Very, very bad news for the banks, but things could be about to get worse. And like I said in that thumbnail, not clickbait, how it could be coming. Look at this next article here. I'll go ahead and adjust it so you can see. U.S. State Department issues worldwide caution alert as tensions in the Middle East soar. And I'll go ahead and bring this up here. We'll go ahead and bring this up here. So the U.S. is seeing stepped up drone attacks in Iraq and Syria, while an American destroyer in the Red Sea intercepted cruise missiles and drones fired toward Israel by Houthi rebels in Yemen. Now, you know what the most concerning thing I think is? What we are doing right now at the border in the south is there's been hundreds of known terrorists infiltrate the border. And what the US is doing is absolutely crazy. They need to protect the border at all costs because, again, this affects the markets. If there's uncertainty, if all of a sudden a bunch of attacks happen in the US, we could see much more market volatility and uncertainty. And this is like a Trojan horse situation. Remember that ancient Greek story, the city of Troy. They said, we're too big, we're too powerful to fall. But it was only until they were attacked from the inside, okay, that's when the mighty city of Troy fell. And if the US keeps on letting these known terrorists in, we're going to see absolute anarchy, okay? And they need to do something ASAP, and this will affect the markets, and that's why I'm talking about it. Now, also, Powell has just recently done some speeches lately. I'm just adjusting this here so you can see it. And he didn't give the markets what they wanted. Powell says inflation is still too high and lower economic growth is likely needed to bring it down. So he's saying here, inflation's still too high. He's telling you we're going to bring on a recession. And like I've talked about in previous videos, there's never been a time in history where the Federal Reserve has lifted interest rates this aggressively and there hasn't been a recession. And because there's so much leverage in the system this time, I think it won't be a recession. I think it will be a depression. Now, something very, very interesting happening in the markets right now with bond yields. So there's been huge volatility. The 10-year, which I'll go ahead and bring up here, it pretty much kissed 5%, okay? We can see on this chart here, we'll go ahead and adjust it here so you can see. It pretty much hit 5%, 4.99%. Now, here's why it doesn't even matter what the Federal Reserve does if they do not lift interest rates. Because what makes mortgages go up, what makes credit card go up, what makes personal loans go up is the 10-year US Treasury. This is where banks get a lot of their funding. And we can see here, just since September, okay, the 31st of August, the 10-year has gone from 4.1% to almost 5%. That's a 90 basis point increase. That's like the Federal Reserve this month announcing they're going to do a 75 basis point rate hike or lifting interest rates 0.75%. So even if the Federal Reserve does nothing, even if they don't lift interest rates this meeting and the next meeting, it doesn't matter because interest rates on the 10-year have already increased almost 1%. And this is going to flow through to all consumer credit, okay? So if it breaks 5%, we're going to see things really begin to break in the financial system, which I'll show you in a moment. So Thursday reports were also mixed. Applications for U.S. unemployment benefits dropped to the lowest level since January as the labor market kept powering ahead. Again, I think this is just seasonal, but this does put more pressure on the Federal Reserve to hike. It is inflationary. Sales of previously owned U.S. homes also fell to the lowest levels since 2010 as affordability worsened even further. Now, this proves it's just a matter of time, people. Once we see the unemployment rate tick up, the housing market is going to have to tank. These rates are unsustainable. Investors looking to invest in real estate, it doesn't make sense. You're going to be negative cash flow like $1,000 a month buying these single family homes in here. Same here in Australia as well. Now, you're probably wondering, well, okay, if the 10-year does hit 5%, what does that mean for the markets? Well, it will mean falling stocks, climbing mortgage rates. So this is why the treasury market is $25 trillion and is considered the bedrock of the global financial system. And what I'm starting to see in the bedrock of the global financial system is we're starting to see cracks. So soaring yields on US government bonds have wide-ranging effects. The S&P is down about 7% already from its highs this year, as the promise of guaranteed yields on US government debt draws investors away from equities. Mortgage rates, meanwhile, stand at more than 20-year highs, weighing on real estate prices. And again, this is what I spoke about yesterday. If the 10-year US Treasury or even a 1-year or 6-month bond goes to 6%, why would you risk putting your money in the stock market when the stock market is severely overvalued, when you can get an almost guaranteed return of 5 to 6%? Especially a lot of retirees, they were forced into the stock market over the past 10 years because they couldn't get any yield. But all these retirees, and I know a lot of my viewers are over 55, so you're either going to be retiring soon or you are a retiree. A lot of these retirees are just simply going to put their money in bonds and just collect the yield on bonds. They don't want to risk putting their money in stocks, which are just severely overvalued, as well as real estate, okay? So this is going to have big effects on the stock market. They're going to have to reprice. So also it says, as Treasury yields surge, credit market spreads have widened with investors demanding a higher yield on riskier assets such as corporate bonds. Now, this is why in this article here, which I showed you, corporate bankruptcies are increasing, because why would you risk buying a corporate bond only paying 6% when you can get 5% from the government? So corporate bonds are going to skyrocket over 10%, especially for much riskier bonds. And all these zombie corporations that could survive when interest rates were 2 or 3%, well, they're going to go bankrupt. So volatility in US stocks and bonds have bubbled up in recent weeks as expectations have shifted for the Fed policy. Anticipation of a surge in US government deficit spending as well. This is something which I think the markets are overlooking massively. The government is spending crazy when we have high inflation. They're spending crazy when interest rates are going up. And every 1 percentage point these treasury yields go up, that's another $300 billion the government has to pay in interest. So imagine if we get into a global conflict, the US government spends trillions and interest rates soar. There's simply no way around it, everyone. The US government could default. So I'll go ahead and adjust this here. And debt issuance to cover those expenditures have also unnerved investors. So this is supply and demand. They're in so much debt, they have to issue more and more bonds to keep on borrowing. At the same time, investors don't want to buy them, and the Federal Reserve is selling bonds as well. So everyone, there is so much uncertainty in the markets right now. The banks are in big trouble. If interest rates keep rising, the bonds on the balance sheets are going to keep dropping. Stock market simply has to crash with yields at 5%. It doesn't make sense to buy stocks right now. But something that is surging is gold. Gold is nearly at $2,000 an ounce. And how quickly has this happened, everyone? Let's go to see where gold was a month ago. I'll go ahead and move myself so you can see this chart of gold. We can see a massive reversal. Just a month ago, it was at 18, not even a month ago, on the 5th. Okay, so what, 15 days ago, gold has gone from 1831 to nearly $2,000 an ounce. And yes, while it can be very boring to hold gold, you know, when everything is booming, when stocks are booming, again, that's why I said you always want to have gold as insurance, because when things really hit the fan, when inflation surges, when people lose faith in the US government repaying the debt, when global conflicts break out, when a real recession hits, not, you know, this a recession when they say, well, is this a recession? We don't identify this as a recession. When a real recession hits, gold will move violently. And if you're wanting to learn how to master the cycles of gold, and also what we can see here, Bitcoin is up a bit today as well. If you're wanting to learn how to master gold, silver, Bitcoin, you can click the top link in the description where I teach you everything about the gold, silver, and Bitcoin markets, because you have to hedge against both scenarios. If, for example, everything turns rosy and the Federal Reserve starts printing money again, lowering interest rates, Bitcoin will surge as well. So you can benefit from the uncertainty. You can have that safe haven. And I'll go into how you can break down your portfolio in that course. But you can have some Bitcoin to hedge against a market melt up as well. So everyone, definitely going to be very, very uncertain times ahead. What do you all think about this? Thanks for watching. You're awesome. I'll see you all in the next video.